Mullen Automotive stock has officially slipped into 5-cent territory. That's right, as of today, MULN closed at just 5 cents per share. For some, this might seem like just another drop in a stock that's already been written off. But in truth, this is another major milestone in what's become a slow-motion unraveling of one of the most volatile tickers in the EV space. Let's talk about what this means, and how both company-specific issues and macroeconomic headwinds are playing a role in the decline. First, the obvious: this is not an isolated one-day dip. This is the latest leg down in a long, painful descent. MULN has lost over 99% of its value in the past year, even after multiple reverse stock splits designed to keep it above the Nasdaq's $1 minimum bid price. And just last week, Mullen filed an S-1 registration statement allowing for the sale of up to 200 million additional shares, a move that was widely interpreted as another dilution bomb. That announcement alone sent the stock plunging from around 8 cents to the 6-cent range in a matter of hours. Now, with shares touching 5 cents, we're in true penny stock territory. The kind of level where the perception of the company starts to shift, not just as a struggling EV firm, but as a potentially distressed asset. Retail traders know what this means. Institutions generally stay away from stocks at this price point, and the risk of delisting becomes a very real concern again. But here's the twist: MULN's current situation is no longer just about dilution or missed revenue targets. The broader macroeconomic climate is also starting to weigh heavily, especially the fallout from Donald Trump's new 25% Liberation Day auto tariffs. Although Mullen is a US-based EV company and proudly touts that most of its components are sourced domestically, the broader industry impact of these tariffs is still significant. Global automakers are reacting. Audi has halted US imports. Volkswagen is seeing its stock slide. Supply chains are being re-evaluated in real time. And while Mullen may be somewhat shielded from direct tariff exposure, it doesn't exist in a vacuum. Investor sentiment toward EV stocks, especially smaller, unproven ones, has soured. With the cost of capital going up, market volatility spiking, and inflation concerns lingering, risk appetite has dried up. That's especially bad news for companies like Mullen that need constant capital infusions to survive. Remember, Mullen isn't profitable. It generated around $3 million in quarterly revenue, but its expenses remain far higher. The company recently announced cost-cutting measures to reduce its monthly burn, but even with those changes, it's unclear how long Mullen can operate without fresh funding. And that brings us back to the share dilution, the central theme in Mullen's recent history. Every time the company raises cash by issuing more shares, existing shareholders are diluted further. And at these prices, dilution has an almost exponential effect. If the share price is 5 cents, and the company wants to raise even $10 million, it would need to issue hundreds of millions of new shares just to get there. That floods the market with supply and pushes the stock even lower. It's a vicious cycle, and Mullen has not yet shown it can break free. Now let's zoom out for a second. There's no shortage of struggling EV startups right now. Lucid, Nikola, Canoo, all have had their share of issues. But Mullen's situation is unique because of how quickly and dramatically it has lost investor confidence. From once being a buzzy speculative play to now trading at a nickel, the fall has been severe. Retail forums that once cheered on every press release are now filled with frustration, cynicism, and even class action lawsuit notices. And that matters, because retail sentiment was a huge part of the MULN story. Without it, there's very little support left on the buying side. So where does Mullen go from here? To be blunt, unless the company delivers a major, game-changing update, whether it's a fleet contract, a partnership with a well-known brand, or a credible financial rescue, the trajectory looks grim. 5 cents isn't a flaw. It's just another number on the way down if sentiment doesn't change. Could the stock bounce? Sure. Anything this beaten down can experience short-term relief or even a technical squeeze. But from a fundamental standpoint, there's little right now to anchor a sustainable recovery. That said, if you're someone who still holds MULN, or is even thinking of buying in, understand what you're dealing with. This isn't a turnaround play, yet. It's a high-risk, high-volatility gamble at this point. The kind of bet where the upside could be big, but the odds are shrinking. Mullen was once seen as a speculative bet on the future of EVs, a possible disruptor in the van and fleet space. But right now, the only thing it's disrupting is shareholder wealth. If that changes, if Mullen can stabilize its operations, secure meaningful orders, and restore confidence, the story could shift. But until then, 5 cents isn't the bottom. It's just a number. Stay cautious. Stay informed.